So welcome everybody, a warm welcome to Developing Superb Trading Strategies. The next webinar today we have the 17th of November 2016. As always 11 o'clock, and as always Stefan Friedrichowski, my name, just call me Stefan, that's absolutely okay. It's a pleasure for me to have you once again here with me. And thanks to Argus FX, the broker who makes those webinars possible, which is quite nice. And I think it's a good offer for you to train yourself, to get information about trading, and especially in this case about developing trading strategies. Before I start, just information that the next webinar is not next week, it's even in 3 weeks. Simple reason, I will tell you, I'm out of office for a little bit more than 1 week, so 1.5 weeks, and that starts on Wednesday next week, and therefore my holiday is in conflict with 2 Thursdays, and therefore we have the next webinar on the 8th of December. Okay, that for you, and you will get automatically information about that as well via email. That's normally 2 webinars next Thursday and in 14 days that they are cancelled simply because my holiday. Okay. Topics for today, of course, once again, we go into this one question from last week, and I will directly transform that question to a general topic here, and that is related to the spreads. And especially in this case to spread monitoring, because I think that is something everybody should do with the broker of his choice, and always look what's going around, and I will show you some strange things happening there. Not at Argus FX, but I will show you a negative detail of what I have observed at a different broker. Already now I can tell you, I will not reveal the name because I don't want really to talk bad about other brokers, but I will show you the example, and I will show you how you will get those results by your own. And then, of course, we continue what we started last week, that was all around pair trading. And last week I used the example Brent oil versus WTI oil. So the 2 kind of oils you can normally trade at our brokers. And we have done already a lot, and we realized, hey, that looks good. So that looks promising, and yeah, last week we ended up only with some percentage changes. So now we transform that in real trading activities with lots and position sizing and so on, so that we have a complete picture. Finally, what I want to do is I want to show you how you can transform that Excel sheet we have prepared for Brent versus WTI, how you can transform that Excel sheet to another pair. And I will show it to you for an example, S&P 500 versus Dow Jones. So that's simply a pair with the basic same idea that in principle they should be with a constant ratio between the 2 values of those indices. But maybe from time to time there are deviations, and maybe those kind of deviations we can trade. And let's look what we find out. As always, you know that there are recordings of those webinars, and you can find them on my YouTube channel, and maybe yeah, you know the link, and if you have any questions or can't have access to that, simply send me an email, and the email should go to Friedrichowski, that's my complicated last name, @argusfx.com. Okay, so I mentioned already that there has been a questions around how to monitor the spreads of my broker, and I mentioned that I not only want to give you the answer in a few words, I want to raise it to a complete topic here as well, and that is a how-to for a spread monitoring. And there is an indicator available in the web, and the name of that indicator is ice.fx.spread monitoring. And if you simply enter those in a web browser, I will do it here just a second. And let's have a look here. That is ice.fx spread monitoring. Maybe I've misspelled it, but anyhow. And then immediately here, the third entry is a web page, isfx.eu, and there you can download exactly that indicator. How to install? I think I have shown it already during other webinars. If you have problems with that, once again, send me an email, and maybe we can do it together via Skype or TeamViewer, so I can help you if you want. So that indicator is available in the net, and what you have to do is, of course, you have to install it, and then you simply throw that indicator on the desired chart, and you adjust the time frame to the time frame you want to monitor. In my case, I always do it on M5 candles, and what is very good with that indicator is that beside the chart you have always in front of you, and I show it to you in a second, all the data of that spread monitoring are stored, and they are stored in a specific folder, a data folder. And how it looks, I can show you. No, that's the wrong VPS. Let's go here. So that's the right one. And let's go for one example. In this case, by the way, it's a Pepperstone, and that's not the example I mentioned in my introduction, that this is a bad example. No. I only want to show you how that spread monitoring looks like, and what you have here is a simple chart, and this chart is the spread versus time. And what you see always, there's one single bar for a single M5 candle, and that bar has always three values: a minimum, so the minimum spread within that M5 candle, and a maximum spread within that M5 candle, and an average spread within that M5 candle. So you have always three values, and those three values are stored in a separate file as well. But what we have here on our screen is we can look already around how it looks like. So if you have something like here, then you see during midnight, and by the way, for those who are in Germany, the time here is 1 hour ahead. So if that is 11 o'clock, then it's 10 o'clock in Germany. So they are 1 hour ahead. And you see around midnight you have that typical spread widening. So the typical spread here, normally the average spread, which is a red line, is around a little bit more than 1 bip. But during the night, you see that increase up to 5 bips, which is absolutely typical. So it's not a bad behavior of that broker, absolutely not. So those values are fine as well. And you get a little bit other results, a little bit better results at Argus FX, but anyhow, so that is a typical example. And you should do those kind of analysis. And you see here that for example, one consequence is around midnight, at least you should not open any trade. You always, and you know that sentence, and I repeat it more or less every webinar here, that whenever you open a trade, you are directly in the minus, and at least by the amount of the spread. So opening a trade around midnight, yeah, then you're minus, then your loss in the very first millisecond is higher than if you do your trade entry at another time. So whenever you have daily strategies, you should move with your entry at least 2 hours later until the spread is in a better condition. So anyhow, so that is a typical behavior, and just to show you how it looks with the stored data, when I open this file, go to MQL4 and then to files, then there's a folder spread monitoring, and here now you see there's always one CSV file. This is absolutely readable. You can import it to Excel or whatever you want, so it's a text file, and then you can look to the data quite easy. So let me show it how that looks like. Oh, I can't open it here on the server. Oh, anyhow, maybe I try a double click. Yeah, Notepad is good. Now we have it here. So you see how that file works. You have always the date, the minute, the time, and then the 3 values, maximum spread, average spread, and minimum spread of that specific candle. So if I would change my time frame to H1, for example, then I would have only 1 line per hour, and so it's your choice how to do it. And you can analyze everything in Excel, for example, later if you want. So that is how spread monitoring looks like. And you can have, in my case, you see I monitor here 28 different Forex pairs. So that's more or less the complete universe of Forex pairs. There are even more strange pairs. You can trade with yeah, whatever currency your broker offers. But that is enough, this 28, and then I can have for every here such a nice graph, and here you see much more that spread widening during midnight, and it recovers later. And if there's something like this, there might be a specific event during the night, either Australian related or Canadian related. I have no idea. So that typically leads to that extreme spread widening. It might be news driven. It's 2:30. So whatever that, maybe some specific news in one of those 2 countries. Then it should be, well, both are possible at that time frame. Okay. That's in general the spread monitoring, and now I want to show you one bad example. So that is neither from Argus FX nor from Pepperstone, which I showed you in the last couple of minutes. That is a spread monitoring result for a broker. The currency, or the Forex pair, is Euro US dollar. And remember what I told you about every single bar represents the minimum value, that's the lower end of that bar, and the higher end is always the maximum of that bar. And what you see here, you see that stepwise function in the minimum of those spreads. What does it mean? Since we see here already 3 days, and that stepwise behavior of minimum spreads is always at the same time. It increases the first time at 8 o'clock, second time at 10 o'clock, and then during the night, and that's not only midnight, during the night later it comes back to normal. So at 7 o'clock in the morning, everything goes back. So nevertheless, what does it mean? In this case, the broker increases systematically the minimum spread value which is available for any trade. That I can say that directly is simply because it repeats every day. Normally, the minimum spread should be always similar, even during the night. But in this case, we have a systematically change of the minimum spread. And my conclusion is that it can only be done by purpose. So it's not random, it's not statistically, it's done by purpose. So during the complete period of 8 p.m. to 6 a.m., we have increased minimum spread values. So whenever you open a trade within the time frame, you definitely have worse spreads than normal. Yeah, that is something you can observe via spread monitoring, and therefore I always recommend to do that kind of exercise for the broker of choice in order to really judge whatever you realize there. So it's for me, it's quite important, and I will continue monitoring those kind of activities, always looking what they are doing, and yeah, and let's continue. And let's, by the way, if you do something like that, and if you want to share the results with me, it would be a pleasure, because maybe we can put those data together and create a bigger database for spread monitoring. So, but nevertheless, I think it's a nice thing to do. Okay. That about spread monitoring, which is really important, because every spread, every trade you enter has a loss at the very beginning already with a spread. But you know, I emphasize and repeat that sentence very frequently because of its pure importance. Let's go back to our pair trading. So we have done already a lot of things, and we created an Excel sheet, and I will show it once again in a minute. But let me recap a little bit how we created pair trading. The pair trading first always considers two underlyings, and the basic idea is that we look for strong correlated underlyings, or even not only correlated, and in this case, Brent versus WTI, we have already a strong story behind. The strong story is simply, it's more or less impossible that only one of those two oil sorts have a huge increase in price, and the other one, for example, goes down or even stays stable. That cannot be for a long period, because the industry would react and buy the other one. So they are not only correlated, they are really related to each other. And therefore, that is always, when I talk about pair trading, that is my premium example. And later you will realize, that it's a good choice. A trade is now considered always as a pair. So whenever we open a trade, we open two, one long trade and one short trade. And that only depends which one goes more up or more down than the other. So what we look for is we build up the ratio so that we divide one price through the other, and we look whether that ratio differs strongly from the typical ratio we have created via an EMA on that ratio. So whenever we have a strong deviation, we believe that this deviation will go back to normal. And we have done it more mathematically in a way that we look always to the distance, so the difference between the actual ratio and the EMA on that ratio. And if that is high enough, that deviation, then exactly is the moment that we open such a pair of trades. And the trade will be closed when the ratio goes back to the EMA value. So when it crosses the actual ratio crosses the EMA once again. The main criticism on normal ratio trading is always, hey, this back to normal might take a very long time. And in my case, since we use that EMA and not this going back to normal as being, for example, 1, we don't have that extreme long trades. Maybe we recap that within the Excel sheet as well, but that was the basic idea. Strong deviations of the actual ratio compared to an EMA on that ratio are the trigger for opening a pair of trades. And we have both directions. If the deviation is to the plus side or to the minus side of the EMA on that ratio. What have been the open points? The open points have been that definitely we have to include the spread of our underlying. Then we have to ask ourselves, what will really happen if we would go without a stop loss? We realized already that to have an individual stop loss on that single trade does not make sense at all, because this pair trading profits directly from the opposite movements. So just to have a stop loss on a single trade would ruin our strategy. Maybe we should have a stop loss on that pair, but even that is questionable. But let's see directly in the Excel sheet. And much more important is how to calculate the position size of the next trade. So that will be done during the next steps. Let's first go back to what we have already. And I have already included now the spread values, but I will show you how. Let's recap a little bit how the Excel sheet works. We have the prices for WTI, we have the prices for Brent, we build up the ratio, we build up an EMA on that ratio simply by the standard formula. And now the important step is that we build the difference between the ratio itself, so the actual ratio, and the EMA on that ratio. And whenever that one exceeds to the plus or to the minus a certain value, and we use here just the multiplier on the standard deviation, so that is a parameter we might change, and the EMA, by the way, is a parameter as well, so now marked in yellow. And whenever we have that axis deviation, then this is called an entry. So, and what we do is we look, hey, do we have an ongoing trade? We store, we remember what have been the start values for the Brent and the WTI trade, and finally we look for the exit of that trade, and the exit is always done when, look here, we opened our trade at a very high plus value of this ratio minus EMA, and in the moment this goes to the negative, that is we interpret it as being back to normal, and then we stop that trade. Okay, so that was already done, but now you see I have introduced extra cells, and those cells describe the spread. In our case, at Argos MX, by the way, for example, we have spread values of 0.03 for Brent and WTI. I have not done the spread monitoring on that, but at least I want to show you how I look to the values quite fast. Let me look where I have it. No, this is the wrong one here. Now we have it. So look to the left, and I will wait until the screen is there. Then you can simply look to the numbers of Brent and WTI, and if you in this case, you can use your eyes in order to calculate the spread value because it's always more or less constantly 0.03, and the same value is valid for both kind of oils. So that is a spread value. But now how to introduce it? And let me describe it a little bit here and mark whatever is needed, because we have to consider the spread into the right direction. So we cannot simply take the result of our trade, and the result of the trade is there's an end value for WTI and the start value for WTI for that specific trade. We have also to consider what kind of direction was trade, and therefore that has an impact on the sign. And you see, we have had already this minus R9 here, looking for the direction of that specific trade, but we need to calculate it in the right way with a spread as well. Therefore, I introduce the spread here and multiply it by the same minus R9. That I have done something right. Let me cross-check, and that's the same I did when I created the Excel sheet. Look for the number here. This is 0.84%. That was a trade result of this trade on WTI. By the way, that has been a short trade. You see entry 29.91 and end value was 24.67. So it went to the south, and that was a short trade. And we have a positive value of the percentage difference. And let me make the spread 0. Then you see I have done everything right. Why can I say that? Without a spread, so with spread 0, I have 0.96% profit of that trade. And having the real value of the spread, now the trade is a little bit worse. And then I know I have done everything right. Same should happen. Let's go back here and focus our eyes on that value here. So in this case, that was a minus value for that specific trade. And go back to 0 spread. And you see, then the trade was not that bad than with a spread. So I have done it with the right sign, and the spread is really entering now every trade. I have done the same for the Brent, and now we have our results including the spread. And for a second, let's focus our eyes what now really happens with our complete result. So looking to the equity line, and you know, we build up the sum of every percentage change of a single trade, and that is a yellow line, which is more or less an equity curve. And let's go back here with 0 spread. Then you see, I go back, then it's easier. So we are at a level of 225% total gain, total win, and with a spread, without a spread, we are already at 250. So we have lost something within our equity, and let's turn the spread of the Brent as well to 0 back, and then you see a further increase of our equity curve, and that means we have done everything right. So now we can introduce a spread. We have that done. Okay, we lose a little bit profitability of the strategy, but not too much. That is still quite a good value. But now the tricky part comes. And the tricky part, which has to be done, it's nice to have all trades in percent. And we have done all the summation in percent. So we simply sum up all changes of all single trades. But finally, we do not trade percent. So what we do is we open a trade, a long trade and a short trade. What we need is a lot size and the right one, especially looking for pair trades. Now we have two things we have to keep in mind and to be sure that we do everything right. Let me first go back to my slides in order to introduce what we need to do right. The first thing is in general related to the position size of a pair trade. Whenever you do pair trading or neutral trading or ratio trading, spread trading, however you call it, then a very important statement is that the short and the long trade, they have to be of the same weight. That sounds maybe a little bit funny, but what does it mean? They should have the same weight. Just an example. Let me assume the WTI has a price of $15 and the Brent has a price of $12. Now I can introduce what I mean with both trades must and should have the same weight. For whatever reason, and that is a number which we will calculate later, for whatever reason, I definitely want to buy 0.56, and that's only a fantasy number, 0.56 lots of WTI. So that is now set. The question is now, what is the size in lots for the Brent trade? Under the condition that both trades should have the same weight. And that means we have a very simple equation. I wrote it down here. So we know we want to trade the WTI trade with 0.56 lots. And now we multiply that with the price of the current price of WTI. And now this should be equal to whatever lot size X we want to trade for the Brent trade times the price of Brent, which is $12. And now it becomes quite easy because we only have to solve that equation for X. I think that is done quite easy. So finally, we have the equation 0.56 times 15 divided by 12, and that equals to 0.7. So the equivalent lot size for the Brent trade is 0.7, because now for those two initial prices, WTI 15, Brent 12, now both trades have the same weight, and that is a must for pair trading. And you might think, okay, the prices are always close to each other. You are right, at least for WTI and Brent. But think, later we want to translate that strategy, for example, to S&P 500 versus Dow Jones. The one is at about 2,000, the other is at about 18,000. the value of the index. And yeah, now we definitely need a complete different weight of both sides. We need the same, sorry, that was wrong telling. We need definitely different lot sizes for each individual trade in order to have the same weight on both sides. So that is extremely important. Why is that important? It has to do, we think about percentage changes of both underlyings. So we know there's a certain deviation, and when this comes back to normal, we calculate it within our Excel sheet, the percentage change from trade entry to trade exit. Finally, we want to have not percentage. Finally, we want to have lot sizes, and finally, we want to have a translation between our percentage change and the lot size. By the way, one additional remark here: if you want to create pair trades, and I simply in brackets name them within different currencies. What do I mean with that? There's a quite nice or easy example. If you consider the DAX, all DAX trades are euro-related trades, or you even might name the DAX itself and give it a euro behind the number. So not the DAX is at 11,000. No, it's worth 11,000 euros. And it's different if you trade, for example, S&P 500, because that's about 2,000, but dollar. So in principle, when you do that same weight concept, then you have to consider the exchange rate between the two indices as well. So then in this equation on one side, even the exchange rate euro, US dollar should enter that equation. But that's only an additional remark if you do pair trading in two currencies. So now we know how to create the same weight concept on both sides of the equation. But there's another thing to do. You know that we have done all our calculations in percent. So the complete strategy is always considering every trade up to now only in percent. So we look for percent changes for the one and the other trade. But of course, we cannot trade percent. We have to translate this in euro or in dollar. The basic assumption now, in order to get that right, is that we do the first set. And what we do here is we set in finally a 1% should equal a specific amount of dollars. You know that whenever you have a 1% change in an underlying and you trade that with maybe one lot, and you get finally a trade result of $25. If you double the lot size, then you double the trade result. But we have now to translate percentage of anything into a real number with a currency. So, for example, in my case, $50. And now that makes it possible that we finally calculate and determine our lot sizes. Just an example, because there are a few steps you have to do when you do such a kind of calculation. You have to consider first how the trade is done at your broker of your choice. And that means, for example, if you look for Argus FX, then we have to look if we would trade one lot of that CFD, and if the price of our underlying, the oil price, would change, for example, by $1, what would be the result of that trade? And for Argus FX, in this case, this equals to $100. That might differ at other brokers. That's not universal between our brokers, but for Argus FX, that equation is right. One lot trading and the price change of $1 leads to a trading result of $100. So that would be the change in your account. And now I give you simply the final answer. So it's how to calculate. If we want to set finally a 1% within all our considerations within our Excel sheet, then the lot size for a single trade is calculated like this. So we take that number, this $50, and we divide that by the oil price, so whatever, Brent or WTI. Then we divide it by the point value, and the point value in this case, is simply $100. I call it point value because for a one lot trade and a $1 change, the result is $100. And this has to be multiplied by 1%. And why 1%? Because that was our initial equation. We want to have 1% being $50. If you do it once or twice, then you realize, hey, yes, that's right. It always takes a minute to get it right. And you can simply cross-check this finally by doing a fantasy trade within a demo account. You could do it even in a live account, but then only do it for something like buy limit or sell limit in order to prove that your calculation is right. So now we know if I want that a 1% change in my underlying would finally equal $50 in my trading account, then I should trade at an oil price of, for example, 45. Then I have to trade 1.11 lot. And if now the price of the oil goes up or down by exactly 1%, then my account would go up or down depending on trade direction and the sign of the change, exactly by $50. And that was our desired result, that we have everything which is related to a 1% change should translate to a $50 change in our account. And that would mean we should trade 1.11 lot. You see, if you go to the equation, if I would say, hey, I want to have 1% should equal 500, then immediately we would trade 11.11 lots in this case. And we have to do the job always for your broker of choice, because this point value might differ, and even sometimes currencies might differ. So having said how to translate percentage changes into real currency numbers and how to do this concept that if you do pair trading, you need, sorry, that was one too much, that both sides need to be the same value, we can translate that to our Excel sheet as well. And that is already done here. So I go further to the right within my Excel sheet to the so-called floating. I will follow up in a second because it's an important number as well. But let's first go through the calculation of our individual trades. So let's go here. So I have marked everything which is necessary within here as well. Let me, oh, sorry for that. those numbers look a little bit strange. I will change, I give them a format first, and then we can show how I have done all the calculations. Okay. So now what I have introduced here is the same which you saw before on my slides. So I have here the specification of what we trade, and that is that one lot, if we trade one lot, that this translates to a $100 change in my account if the price of the oil would change by $1. And since I cannot refer calculations to this equation like $1 oil equals $100, I put in the same number, this 100, in the cell below as well. And the other one I put in that Excel sheet is my target value, the target of what should be a 1%. And remember my slides, I mentioned, hey, I want to have a 1% should equal $50. And once again, since I cannot refer here, I put the number here as well, because then I can refer to that. And what I have done here is now simply translate the equations of my slides, and you see still the same kind of formula, even not seeing directly what numbers are referred here, but that's exactly how it's done. And I have done one additional step to take that into account as well. And the initial or the additional step in this case is, you see, the first trade should have been opened with 2.0072 lots. Okay, in this case, and we have to translate it to the broker of choice. And the specification of Argus FX, for example, is that they have a minimum lot size for trades in oil, and that minimum lot size is 0.1 lot. Then later you can trade 0.1, you can trade 0.11, 0.12, and so on, but you cannot trade 0.09. And that I have done here as well within the Excel sheet to have the exact position size. And that is, in my case, not that important. But if I would further reduce my risk, and that means I put smaller numbers here for 1% should equal $50. Let me just go one decade down. Then you see, now it becomes close. So now we need exactly both. For those numbers, we do not need the minimum lot size, really, but at least this step function we need. But later, and that's the case when the oil price went up, let me see when that happened. And now you see, we have always here in the real trading consideration, the minimum lot size. If you look what the should be lot size is, then you see other numbers. But I cannot trade those numbers, and therefore everything is done correctly within the Excel sheet. So now back what we have. And now we have an equity line which is really in euro, or in this case in dollar. I have done everything in dollar because we trade oil, and that is traded in dollar. That there's still, if you trade it in a euro account at Argus FX, everything would be translated to dollar as well, to euros. But anyhow, so now we have the real equity line in a currency. So that would mean that would be the backtest result of that pair trading strategy based on Brent and WTI. And you see, within those years, I think we use data from 2000, so 16 years, that would create that total gain. And of course, now I can say, I want more, and that is simply entering here a different number. For example, the equivalent of 1% should be $100, then everything doubles here. Let's go back to the original value, because we have still something absolutely not considered. So first conclusion, still we have a profitable strategy, everything is fine, that's good. But now let's go back to what I have introduced here by so-called floating trade WTI and floating trade Brent. What does it mean? The number means based on the close value of a candle, I look what is my current situation of both ongoing trades. And we start a trade here, and then after the first day, the one trade, WTI, is plus 0.4%, and the other one is minus nearly 0.8, and that would sum up the sum of those both ongoing trades, and therefore I call those columns floating trade results, because yeah, they are floating, they are ongoing. So I would have a minus here for that ongoing trade. Then finally the trade will be closed, and this is here, and there's a new trade coming up, and so on and so on. Why do I have done this kind of exercise? And we can immediately switch to let's first do it this way. So let's have a look to that. Sorry, just a second. So now I'm back. Let's look for those floating trade results for our strategy. And let me do it this way, because then it might tell you more. Then you can see this is a complete period of time. We consider that there are some examples, but only a few, where our floating trade result to the minus is lower, so let's say higher or more severe than 10%. So we have a 10% loss. And it even, the worst number is at 20%. The good thing is, and we could show, could show you the exact details of the trade. Finally, this trade was a plus trade. But at least what we have to consider, that this trade has, our account might have a problem, because temporarily we are on a big minus within our account. How much? Now we can translate everything, because remember, we set our position sizing of the two trades. We set it up that we can translate percentage to real numbers in euro or dollar. And you remember that in my case, I put 1% should equal $50. So then you know already that this would be a $1,000 temporary loss in my account, even if the trade finally went to a plus trade. But we have to survive that period. Since we can now translate everything to euro values, so percent values in euro values, and this is our dollar values. So I have done it here already, and you see what we expected from our own calculation, that our account should survive a temporary loss, a floating loss of $1,000 within that example here. So that means, if we look back to the equity curve, which looks nice. We have to keep in mind that temporarily we have to survive a floating loss of $1,000. And think about this might happen at the very first trade. Then we need an account size, in this case, of about $2,000 in order to have still margin and to have that trade up and running. But that is only a rule of thumb now. So a $2,000 account would be enough to trade that kind of strategy, and calculating always everything with those lot sizes. And you can change the numbers by changing those two. This one, the first one, cannot be changed by you. That cannot only be changed by the broker. And that's a point value for your broker of choice. And the other one number, of course, you can change. And that has to be related to your real account size. In this case, we realized that at least we would need an about $2,000 account. Then we can trade directly as written in that Excel sheet. We would take those lot sizes and so on and so on. But we know historically, at least there have been a few points where we have to survive temporary high losses. And this is exactly the case here. Even if the trade finally went back and was a positive trade, we have to survive that kind of situation. So now we have everything done, that we know we have a profitable strategy, we know how to calculate our account size, and we can trade this strategy whenever we want, and it's only up to you. And it's always your decision to follow such a strategy, but always you do it on your own risk, that's for sure. And you know that even if I make that statement here. So now I see the time is already, time progress very well, but that means I have to postpone what we have to do with S&P 500 and Dow Jones to the next webinar. I already open here what has to be done, and you can do it by your own if you want. I can send around the spreadsheet if you want for Brent and WTI, of course, and I would share it with you. But since the time is already 1 hour, let's do that step at the next webinar. And please remember that the next webinar will take place in 3 weeks, or to be exact, with an exact date, it's the 8th of December 2016. I hope that it was quite informative for you once again here to see what else has to be done when we realize we have a profitable strategy, but only based on percent. There have to be done a few steps more in position sizing and this equal weight concept for a pair trade. Maybe it needs a little bit time to get those formula right, or to get that formulas into your head. It's always a little bit complicated, but finally I'm sure you will manage it. So for me it was a pleasure. I hope for you as well. And then see you again in 3 weeks. But in case you need any assist or any help in the meantime, just send me an email as always. That is always true, and even within my holidays. Okay, thank you very much and have a nice day.